Good morning. Welcome to our regular second Saturday webinar. Today I am using a new laptop. Hope it will audio and video will have much clarity than what I have used last time. In today's presentation, we are going to focus on market valuation as well as the theme to focus for next year, that is 2022. I have put lot of important slides. I hope it will be useful to you. We will start the webinar. In the last 1 month, market has seen some profit booking. Especially it is due to heavy selling by foreign investors. Foreign investors consistently selling in our market on a daily basis. They are selling 3,000 crores, 4,000 crores like that. In the month of November alone, they have sold more than 4 billion. And in October, they have sold 3 billion. So if you take from October 1st, foreign investors have sold more than 9 billion worth of shares in our market. But most of the selling has been absorbed mainly by retail investors as well as domestic institutions. Large number of retail new first time investors has entered the market and they are consistently buying. Also indirectly through mutual fund, domestic retail investors has been continuously buying. That is why in spite of heavy selling by foreign investors, our market did not tank and we have seen just 6% correction from the top. Nifty, it went up to 18,600. Now, as on yesterday, it closed around 17,500. So it's a normal correction. We had it mainly led by selling by foreign investors. If you see the broader market, an interesting thing is happening. What we have seen in the last 6 months back was that almost entire spectrum of market was going up. But now market is seeing some divergence where select stocks were going up as well as many stocks also drifting lower. If you see in the last 1 week, a company called Network 18, which runs the TV channel CNBC, that stock went up by 50%. Like that, so many stocks are seeing vertical rally on one hand. On the other hand, many stocks are seeing profit booking also. Many stocks from FMCG sector. For example, Colgate touched a 52-week low 1 week back. Similarly, many stocks were drifting lower. So on one side, you are seeing a lot of speculative action taking place in broader market, whereas on other side, many stocks are seeing profit booking and they are drifting lower. So there is a huge divergence in the market happening. If you see global markets, they are in consolidation and they are not moving much. Dow Jones 1 day going up, 1 day coming down, and in that it is happening. And global markets are mainly seeing some consolidation. Crude oil prices extremely volatile. On a single day, it fell by almost 13% on Omicron fear. Now again bouncing back. Crude oil prices are very important for our country. As whenever crude oil prices goes up, our rupee used to get depreciated, and the similar thing has happening now. Crude oil prices went up very sharply in the last 2-3 months. Our rupee has now depreciated well above 75 to the US dollar. Yesterday closing was 75.75, which is a near-term high for our market. Because on one hand, crude oil prices were going up, and on the other hand, capital outflows are happening through foreign investors, which has made the rupee little weaker. And overall, if you see, Nifty and Sensex were down around 3% in the last 1 month. Mid cap -2, whereas small cap was holding on and did not fell. As I told that in broader market, lot of speculative action were happening in small cap stocks. One example I gave was this Network 18. Like that, many stocks were going up vertically, which is holding the small cap index. And many retail investors who are in the small cap segment, they don't feel that a major correction has been happening in our market. Whenever market goes up, everybody used to ask whether the market is overvalued or undervalued or it is fairly valued. So one parameter historically we used to see whether market is overvalued or undervalued is the PE ratio, which is the price to earning ratio of the index. So we have two major stock exchanges, NSE and BSE. Both have their benchmark index. One is Nifty and other one is Sensex. Nifty has 50 shares, whereas Sensex has 30 shares in the index composition. And whenever market goes up, generally all institutions used to gauge the overvalue or undervalue of the market through this index PE. If index PE is high, market used to said to be high overvalued, whereas index PE is lower, market said to be undervalued. Some of the mutual funds like Balanced Advantage Fund, they tend to invest according to the PE ratio of the index. For example, if Nifty PE ratio is less than 20 means they increase the exposure in equity, they feel that market is undervalued. And if Nifty PE ratio is higher means more than 30 means they reduce the equity exposure and increase the debt component. So the index PE is very important for many of them to take decision. And if we see now the index PE, both Nifty and Sensex I have plotted in the last 1.5 years index PE I have put. In March 2020, which is this is the date in which COVID low has happened. In that, if you see that Nifty PE was 17, whereas Sensex PE was 15. But after that, market started going up very sharply, and in spite of lower earnings, market went up because at that time the COVID disruption was there and lockdown was there, so there was no earnings for the companies. So market went up and PE ratio also went up. There is one important difference between calculation of PE between Nifty and Sensex till March 31st. Till March 31st, Nifty used to calculate PE ratio based on the standalone earnings of the company, whereas Sensex used to calculate based on the consolidated earnings of the company. Usually consolidated earnings used to be high. That is why you see that Sensex PE always tend to be lower than Nifty PE till March 30. And if you see on March 23rd, the Nifty PE was 17, whereas Sensex PE was 15. On March 30, the Nifty PE was 40 and Sensex PE was 34. But from 31st onwards, what NSE did was that they also started calculating Nifty PE based on the consolidated earnings. And if you see from March 31st onwards, almost the PE ratio became same, 33 PE for Nifty and Sensex was 34. Then the company started announcing their earnings, and in spite of market going up, the PE ratio fell because PE has two components. One is the price, which is the index, and second is the earning, E, which is the earnings of the combined earnings of the index companies. As the earnings started going up, the PE ratio started falling. And if you see, as on 8th December, the Nifty PE was 24, whereas Sensex PE was 27. One interesting thing which you can note from this slide was that on 31st March, Nifty PE was 33, whereas Sensex PE was 34. That means Sensex PE is slightly higher than Nifty PE. Whereas on 8th December, if you see, the Nifty PE was 24, whereas Sensex PE was 27. Almost a 10% gap was there. So the reason why the huge difference between Nifty and Sensex PE came during the last 6 months was that this is due to the composition of the shares in both the index. Nifty has 50 companies, whereas Sensex has 30 companies. Some of the commodity related companies like Hindalco, JSW Steel, BPCL, IOC, ONGC, they are all present in Nifty index, whereas these companies are not present in Sensex. These companies showed huge profits, which led to higher earnings of the Nifty, and that is why the Nifty PE has come down very sharply. Whereas Sensex, because of a lack of commodity companies, Sensex PE did not fell like that of Nifty PE. That is why when compared to March and December, the PE ratio of Nifty has come down sharply, mainly because the earnings has gone up in the Nifty companies, whereas in Sensex company, that benefit they did not got it. That is why the Sensex PE was higher than the Nifty PE. And historically, if you see, if you see the Sensex PE chart ratio, I have plotted this from 1990 onwards. It's a very interesting one. If you see the last 30 years of Indian history in Sensex PE ratio, if you see that it used to trade around 20 in 1990, then the Harshad Mehta scam came. At that time, the Sensex PE was almost went near to 60, and then the scam came, and then the index fell very sharply. At that time, Sensex was around 6,000 level. Then it fell very sharply. It fell more than 50% at that time when the Harshad Mehta scam came. Then the PE ratio also fell corresponding to the market fall. Then again there was some pullback because of earnings. Also the PE ratio, because of market pullback, the PE ratio went up, and then again the market started falling. And the second fall was mainly due to earnings pickup. And earnings, when improved, the PE ratio fell, and it fell very sharply to in 1999. The PE ratio fell to almost 10 levels. Then the dot-com bubble came. All the index shares were changed from old economy stocks to IT stocks and other stocks, and the overall index PE ratio went to more than 30. Then the IT dot-com bubble burst. Then again it fell. Again in 2007, the Sensex went up very sharply, and the index went to Sensex PE went near to 30 level. Then that crash, global economic crisis crash came. Then the PE again fell to 10. Then again went up, and there was a long consolidation. And during the COVID time, if you see the PE ratio, when market fell very sharply last year in the month of February and March, then again PE ratio fell very sharply to 17. And then after that, it bounced back. Market staged a V-shaped recovery. Then PE ratio went up very sharply. And then from there, again, it has come down from around 34, 35 level. It has come to around 27 level. So the PE ratio, if we see, means it used to go up and down. But one important thing what we can see is that whenever market goes to near to 30 PE, like that, 3 times it has happened like this. 30 or above, the PE ratio used to fall very sharply. Here in 2000, the PE ratio went to 30, then it fell very sharply like in the next 2 years. Similarly, in 2008, when PE ratio went to 30, it fell very sharply. And then in 2020, PE ratio went near to 30, then it fell very sharply. So in the past, historically, if you see 3 times, whenever the Sensex PE ratio goes to 30 level, PE ratio used to fall very sharply. And now also, PE ratio went up above 30. Now it has come down. And one important thing what we are seeing this time is that at that time and all in 2000 and in 2008 and all, what happened was that market went up multiple times from the lows. And that is the reason why the PE ratio has gone up. But this time, no. What happened was market has just gone up, but there was lack of earnings. That is why the PE ratio has gone up this time. And what we are expecting is that from here on, at least in current year itself, we are seeing earnings is improving, and from here on, earnings will improve further, and which will lead to PE derating. And there are 2 ways PE ratio can come down. One is because of fall in stock prices, and second one is the earnings improvement. So if earnings improve, then the PE ratio will come down. If price fall also, PE ratio will come down. In the past, what has happened in 1990 to 2000 and 2008 and all, market fell mainly because of price falling. That is P by E, the price has come down sharply, so the PE ratio has come down. But now what we are expecting is that PE ratio will come down gradually, but this is due to the not because of price falling, but mainly because of earnings improvement. If earnings improve, then also PE will fall. So we are expecting that price earning ratio of the index unlikely to go much higher. It may gradually come down, mainly because of earnings improvement, not because of price correction. The other 2 important parameters used to see the market overvalue or undervalue. The other two important ratio where many institutions used to see is the market capitalization to GDP, one, and the next is the price to book. And if you see that based on both market capitalization GDP, it is almost highest level now, 112 it is trading. And the previous high it went in the last 20 years was in 2008, it was 103, and now it is 112. So that also the average was around 79. So if you see that overall, if you see that based on market cap to GDP, also the market looks overvalued. Similarly, on price to book, this is the forward Nifty price to book, and in that also, if you see that it is around 3.2 times, and that also slightly, that also almost 20% higher than long-term average of 2.6. So whatever valuation, if you see, means market looks overvalued, and the overvalue can come down either by one of it. One is by price falling down. The second maybe due to earnings improvement. But this time, what we are expecting is that the overvaluedness of the market will come down based on the earnings improvement. That is what our expectation is. We don't expect sharp correction in the market, even though the valuations are looking higher based on PE ratio and price to book as well as market cap to GDP ratio. But by earnings improvement, the valuation will start coming down in coming years. And this is the chart which I have took from the magazine called Mint, and in that they have mapped many countries' PE ratio. And if you see that India is one of the richly valued countries, that is the reason why many foreign investors have turned cautious or turned bearish on India. Only reason was that the Indian market is trading at very high valuation, and if you see that Indian market is trading around 29 PE. This is as on October 29th. After that, in our market, some correction has happened, and the PE ratio has now come down a little bit, but still it is high when compared to other countries. If you see Dow Jones, US Dow Jones, it is trading around 20 PE. And if you see the Nasdaq, which I have not put in, it is trading around 30, 31 PE. Nasdaq is trading, and S&P 500, which is also one of the important index where everyone used to track in US, that is around 29 PE. So S&P 500 and Nasdaq is trading almost in line with our market, whereas Dow Jones, which has only 30 companies, it is trading around 20 PE. The other countries like Germany, the European and Japan, they are trading around 15 PE, and Taiwan is trading around 15 PE. Some of the commodity related companies, Russia is trading around 8 PE, whereas Brazil around 7 PE. Russia, the main source of income was from crude oil, and the last 6 months the crude oil prices went up sharply, which led to higher earnings. That is why the PE ratio is very low in Russia. It is at 8.4. Brazil, mainly commodities, commodity related country, they have a lot of iron ore like that, and generally commodity related country used to trade at lower valuation, and Russia and Brazil will fall under that category. That is why it is trading at very low PE of 8 and 7. Whereas India, if you see, it is trading at very high valuation. Till now, what I have showed was the PE ratio of the index. We all know that index is collective of 30 and 50 stocks, and it is the collective earnings which dictates the PE ratio of the index. But on valuing individual stocks or select sectors, we should not use PE alone. Many times this PE ratio in valuing a stock or a sector will be highly misleading, and retail individual investor should not take PE alone for evaluating a company. There are many other factors. There are PE, price to book, and there are enterprise value to EBITDA. Many other ratios are available. We have to use with that junction, and simply using PE alone for many places will be highly misleading. And some of the places which you should not use PE for evaluation, I have mentioned below. One is the cyclical stocks. Seeing the PE ratio and buying a cyclical stock will be highly misleading. I will give you one example, just a recent example. Tata Steel. The stock was trading around 1,400 2 months back, 1.5 months back, 1,400 to 500. At that time, company announced that second quarter results, and company showed an multiple times jump in quarterly profits in the second quarter. and the EPS in the second quarter was 100 rupees per share. So if you extrapolate for 4 quarter means for full year, Tata Steel should show 400 rupees EPS. The stock was trading around 2,400. That means it is trading less than 4 PE at that time when the company announced that result. But when the result came, the price started falling and it fell to below 1,100. Almost 25%, 25-30% correction has happened after the company has announced results. Suppose if you have seen that the Tata Steel is trading just to 4 PE, and if we have bought Tata Steel share at that time, means you will be in a loss. So for cyclical stocks, never ever use PE alone. What you have to see is that in cyclical stock is the main thing is that where is the current level of the commodity cycle is going on. That is the main thing which will dictate the future price of cyclical stocks. So if you see like that, means generally they used to tell that you have to buy a steel stock when the PE ratio is very high. When will the PE ratio will be very high? When the cycle is at the bottom. And they will also tell that when the PE ratio is less, you have to sell a commodity stock. When the PE ratio will be less, at the top of the earnings cycle. So what market is fearing is that recently the coking coal price has gone up and steel price has come down. So what market is feeling for Tata Steel is that maybe the best quarter profit is over. From here on, the profitability of Tata Steel will come down. That is the expectation market has. That is why in spite of posting huge profits and very low PE, the stock has corrected. So in cyclical stocks, always see that where is the point now in the current commodity cycle, and based on that only you have to take the decision. PE alone you should not take. Similarly, in banks and financials, PE ratio you should not use. You should use only price to book ratio. PE ratio will be highly misleading, and you should always use price to book. That is the main ratio we have to use in financials and banks. And the third one is the company in emerging business. For example, Zomato recently listed. The company is showing running in a loss. So when a company is a loss, means there is no earnings and there is no PE ratio because there is no earnings. So in this type of company, PE ratio, using of PE ratio will be highly misleading. It's an emerging business, and there will always be a fancy for a new emerging business, and market always give higher earnings to that. Market always used to value highly this emerging business company. So at that time, at these types of business, never ever use PE ratio. And the fourth important place where you should not use PE ratio, and using PE ratio will be highly misleading, is a company which has completed huge capex. So whenever company has completed huge capex, what used to happen is that the company has spent money. Then in coming years, the next 1 year, 2 year, company used to get operating leverage from the capex they have spent. And the earnings will go up very sharply because of the company completed capex. And in these places, using PE will be highly misleading, because just completed huge capex, company will always trade at a higher valuation. But once the operating leverage starts kicking in next 1 year, 2 year, 3 year period, the PE ratio will fall very sharply. In the fourth case, I will give you one example. A Chambal Fertilizer, we all know that is a fertilizer company, belongs to a Birla Group. They went for a huge brownfield expansion, greenfield project of a urea fertilizer plant. In the last 3 years, they built the plant, and last year they completed the capex. And if you see that once they completed the capex, the earnings started going up very sharply. Just 1 year back, the Chambal Fertilizer stock would have looked overvalued, mainly because the earnings was not there. But once they completed the capex, now earnings started coming in, and EPS went up very sharply. So has the stock price. So the company which has done which is undergoing huge capex and likely to end the capex in near term, is at that time using PE ratio and taking our investment decision will be highly misleading. So these are the 4 places where we should not use PE alone for deciding our investment. And in previous slides, I told that PE ratio looks high and it will come down. and it will come down mainly because of earnings recovery. That is the thesis, I believe. Why we are going to see earnings recovery in the last 7 years from 2014 onwards? Actually, the Nifty hasn't seen any recovery in earnings. Just a less than 5% CAGR earnings we had it. In the last 6 months, we have seen decent earnings growth, and in current year we are expecting around 20-25% earnings growth in Nifty as well as Sensex. And in next year also we are going to see a decent earnings growth. So whenever earnings goes up, naturally PE ratio will come down, and even if Nifty or Sensex doesn't go up, because of earnings improvement, the PE ratio will come down. And why I see the earnings to see recovery is that what I feel is that, and what I am seeing in the ground level is that there is a very good employment opportunity generated in almost many sectors. Last week, I went to my native place, Madurai. One of my relatives, he completed engineering course 4 years back in civil engineering. He was jobless for 1 or 2 years. Then he joined in one construction company, and they sacked him after because of COVID. And suddenly last week he came and told me that he got job in Canara Bank in Kodaikanal branch. So a person whose life was uncertain for the last 4 years, he got a job in Canara Bank, and he got settled in his life. Similarly, I see a lot of youngsters who just completed engineering degree, and recently almost many of them have got employment in IT sector or in telecom sector or some other sector, except in tour and tourism sector. Almost entire sectors we are seeing lot of employment generation. Many people also switching jobs because they are getting higher salary at a new places. And what I am seeing at the ground level is that lot of employment generation is happening both in India as well as in abroad. Many people are getting job opportunities in US, Europe, like that, and many people are going and settling there. And even if you take US, the many shops we are seeing that they are ready to recruit people. That slide and board we are seeing in US in many places. So the employment generation is very high now, except in COVID affected sector. In other sector, everywhere the job opportunities is there, and most of the young generation, everyone is getting a job now. This was not case few years back. Many were unemployed, and many were joining employment just to take some sort of employment like that. They were joining it, but now they are joining in a very settled manner, and many of them are getting it. So once if they get employment, is what used to happen is that they will start spending money, and that money spending will boost the economy. So the overall employment generation is very good in the main sectors like IT and other financials and other sectors, and which will boost our economy. The second thing is this monsoon was very good in the last 3 years. Last 3 years we had either normal monsoon or above normal monsoon, and that will be very positive for the rural economy. And my feeling is that most of the sectors will do well, and the sectors which has been affected like due to COVID, like hotels and hospitality, and they will improve from here on. The worst they have seen it, from here on there is nothing to get affected, and they will see a much improvement in their earnings from here on. So from next 1 year, 2 year point of view, what I am expecting is that there will be a good improvement in our domestic economy earnings. And this is the this is a slide which I have took it from Naukri job speak index. You all know that there is a portal called Naukri. Those who want to take job, they can post it there. And similarly, suppose if I need some employees, means I can also post that I need these employees with that qualification. It's a very important portal, and many people used to get job through Naukri portal, and they have a index called Naukri Job Speak Index. and every month they will put that in which index, in which sector the job opportunities are high, and which sector hiring growth is there, and which sector is not doing well, where hiring is not happening. All this detail they used to give every month based on the Naukri job speak index they will give. And in November, if you see that the telecom between November this year, that's November 2021 and November 2020, if you see that the telecom sector has recruited almost 91% higher than what they have recruited last year during the same period in the month of November. Similarly, hotels, restaurant, and airlines, which is the unlocked trade, this sector has been affected heavily by COVID lockdown, and the recruitment has improved a lot, from 58% higher than what it has happened last year. Education and teaching, this also has got affected because of COVID. Now some colleges and training institutions, coaching classes for students, they have started opening, and 54% higher recruitment has happened when compared to last year. IT software services, almost 50% higher recruitment happened when compared to last year. Retail, this also has got affected by COVID, and it is 47, and BFSI 30, Pharma 12. The least employment job opportunity created was the FMCG, just 6%. And if you see that the majority of sectors which got by COVID affected, they have started recruiting heavily, and overall almost 26% higher recruitment has been happened in the month of November when compared to last November. So the recruitment is happening at the brisk rate, and we expect that will kickstart the spending, and that will boost our economy. In my opening speech, I told that in today's presentation, we are going to focus on two things. One is the valuations of the market, and second was the theme to focus on. So the main theme which is likely to do well in the next 1 to 2 years at least is the capex revival theme. There are many smart investors in our country, and what used to happen is that even before the actual news comes, they used to buy the stocks in advance. Generally, the retail investors will come to know lately that this company is doing well only after company started posting results only, good results only. But smart people, they used to contact with the management of the company. They took survey from on the ground level to many industrial peoples, and they will start buying the shares much before actual events happen. And one theme, based on that, one theme that likely to do well is the capex revival. So the reason what these smart people are telling is that they are expecting that capex will revive very strongly in the next 4-5 years. One of the reason what they are telling is that 2010 to 20 there was very less capex happened in our country. One of the main reason was that between 2003 to 2010, Indian corporates spent a lot of money in capex, and they built a lot of capacities. So once you build a capacity, what used to happen is that you need higher capacity utilization to increase capex further. But the capacity utilization did not happen higher in the last decade between 2010 to 20, and the capex and the capacity was gradually going up only because the economy was lull and there was not much export demand. But now, if you see that export has been reviving, domestic demand has been improving, and capacity utilization has reached a level which makes the corporates to go for higher capex so that the capacity will get expanded and they can service more products to the demand. So the main reason 2010 to 20 the capex was very less, and that led to higher capacity utilization, which will lead to more corporates to think of the go for capex. And the second reason is that the corporate balance sheet has been extremely strong now. The debt equity ratio is one of the lowest in our Indian corporate history. So whenever the debt levels are low, means it will also force corporates to go for capex. One example I will give: a company called SAIL, Steel Authority of India Limited. which manufactures steel. And if you see that 1 year back, the company has had a debt of 55,000 crores, more than 50,000 crores they had a debt. In the just recently concluded in the second half, the September 2021, if you see that the debt from 55,000 crores, the debt has fell to 22,000 crores. Almost 33,000 crores they have deleveraged their balance sheet. Now just 22,000 crores is the debt, and 3-4 days back when the management came in CNBC, sale management told that in FY23 the company will completely become zero debt. That means debt free they will become. A company which had a debt of 55,000 crores is likely to become debt free in 2 years, means naturally sale will go for big capex in coming years, because their balance sheet is so light that they cannot keep on sitting on the money. They have to go for capex. So the strong corporate balance sheet will definitely force companies to go for capex. The third important thing which will force company to go for capex is the government PLI scheme, which is the production linked incentive scheme. The government is giving tax incentives for companies which are putting new plants, and that will, in majority of the sectors, in manufacturing sectors, and that will force many companies to opt for the PLI schemes. Already many companies have announced their project, and we are going to see the implementation in coming years. These are three main reasons. And the fourth important thing why capex will improve is that now new emerging business vertical has emerged. Electric vehicle, which is where almost entire companies, majority of listed as well as unlisted companies are going for capex, because in electric vehicle segment, we all know that a company called Ola, they have put a big plant in a town called Krishnagiri in Tamil Nadu, and they have made a lot of capex in that, and they have generated a lot of employment. They are going to manufacture a two-wheeler, electric two-wheeler, and it is likely to come by this month, and they are officially going to launch it. The booking and all over, likely it is likely to hit the roads by this month end. In electric vehicle segment, lot of investment is coming. Similarly, the green energy segment, lot of investment is coming, and these two will also kick lot of capex, and it will revive the capex revival. So the capacity utilization is high, balance sheets are very strong, and a government PLI scheme is there. And then we are having the investments happening in electric vehicle and green energy sector. All these things will kickstart the capex, which was lagging in the last 10 years. So how to play the capex theme? The next question retail investor will be asking is that, suppose if IT sector is doing well, we can tell that you can buy IT stocks, 2 or 3 large cap stocks, 2 or 3 mid cap stocks. Suppose if commodities are doing well, we can tell that you can buy steel stocks or metal stocks. So how to play this capex thing, that is more important, because without knowing how to play it, then we cannot participate it. So there are many ways you can play the capex theme. Generally, when capex theme come, it won't be there for 1 or 2 years. It's a cycle. It usually lasts for at least 5 years, because if you want to put a plant, means on a single day you cannot put it. It will take 3 to 4 years to put a steel plant, to construct a steel plant. Similarly, many greenfield projects and that it will take 3 to 4 years. So the capex theme will ride in for 3 to 4 years at least, and many ways to play it. One of the way to play the capex theme is buying the corporate banks like State Bank of India, ICICI Bank, Axis Bank, because whenever company goes for capex, means naturally they will take some loan from the corporate banks, and they will invest it. So corporate banks will be the beneficiary, and it is one of the indirect way to play the capex theme. The next one is the EPC players like L&T and other construction players. Whenever a factory has to be built, it has to be built by them. The third one is the equipment suppliers. Equipment suppliers, because whenever you construct a factory, you need an equipment to be placed in the factory. And some of the companies like ABB, Siemens, Thermax, ISJEC, and these are some of the equipment suppliers, and they will benefit it because they will get the order for manufacturing. And the fourth one is the industrial products. products like ball bearings and precision products, then the ceramic related companies. These are the industrial products and refractory related products, and these are the industrial products that will get benefit from the capex thing. And fifth one is the consumables, which is the cable manufacturers like Polycab, then air conditioner manufacturers like Voltas. They all will come under consumables, and but these are late pickup. The initial beneficiaries will be corporate banks and EPC. The next beneficiary will be equipment suppliers and industrial. The late beneficiaries will be consumables like a Polycab. And these are some of the ways we can play the capex theme. Since capex theme is likely to do well, I have put in our recommendation 3 or 4 stocks which you can play the capex theme. In the previously also we have recommended some of the capex theme plays. And if you see our recommendations, 2 or 3 companies I have included this time in capex play theme. The new emerging business. If you see in our market, 2 type of stocks were going up, whether they have any completely based on hope. One is the electric vehicle segment, and second one is the green energy segment. Whenever a company says that I am in electric vehicle segment or I am supplying to a electric vehicle manufacturer, means immediately the stock price is going up, irrespective of the fundamentals. These companies will do well because they have a hope that all the ICE engine, that is internal combustion engine vehicles, will be replaced by electric vehicle in coming days. And because of that hope, a company which is related anything related to electric vehicle, these stocks are going up. And we have to be very careful in that. Out of 10 companies, 7 or 8 won't do well, 1 or 2 only will do well, and we have to be very careful during the momentum ride. The second one is the green energy, because there has been a deadline has been set throughout the world that each country has to become net carbon zero. So we are using the internal combustion engine burning fuel, as well as we are running the thermal power plant burning coal, which is leading to very high carbon emission. If you want to suppress that emission, means then you have to generate power through green energy. There are 3 ways where you can generate green energy. The one is through wind, that is renewable sources. There is one is through wind energy, where you can install a windmill and can generate power. The second one is through solar, where you can put a solar panel and can generate power. And third emerging one is the hydrogen. Through hydrogen, people are generating a green energy, and these and all are emerging states. The hydrogen is on the emerging stage, and still a lot of research is going on, and it is likely to come in coming years. So in electric vehicle, if you see that electric vehicle, the main source of running the vehicle is the power. If you produce power using coal, means there is no, it won't reduce the emission, because what will happen is that instead of using petrol or diesel, you are using coal. It won't reduce the carbon emission, because all the coal power plant will emit lot of carbon. So it won't reduce the carbon emission. So a pure green electric vehicle is the one where the power has to be generated through green source, that is either through solar or wind or through hydrogen. Only if you generate power through green hydrogen. There are 3 types of ways you can generate power from hydrogen. One is the green hydrogen, the second one is gray, the third one is the blue. If you generate power through green hydrogen only, it will come under green energy. Otherwise, it won't come under green energy. So for an electric vehicle to become pure green energy, means green electric vehicle means the power which is used for charging the electric vehicle, it should be generated from either green hydrogen or through windmill or through solar. Then only it will become a green electric vehicle. Otherwise, it won't reduce the carbon emission, because the whatever emission we are reducing through running of electric vehicle, it will be increased through running of the thermal power plant. So these are emerging business, and it will keep on changing every now and then for the next 5 years, 10 years. And while buying the company, we have to be very careful because no one knows, because since this is an emerging business, no one knows what will new technology will come, and we have to be very careful. The renewable energy, solar and windmill are old technologies, they are not new one. Someone who is in the market for the last 30 years, they will be knowing a company called NEPC Micon. It is one of the oldest company in 1990s, which first installed the windmill. At that time, the stock price went up very sharply on expectation that the renewable energy windmill will do very well in coming years. But unfortunately, if you see now, the company has disappeared. Like that, many companies in both electric vehicle and green energy will disappear, and we have to keep on tracking that company once we buy the share, because in market every now and then lot of stories will be told, and only we have to be careful in selecting the companies. For momentum ride, you can buy any shares, but you have to keep the exit policy correctly in new emerging businesses. Auto sales, it was very weak, and if you see that passenger vehicle was down by almost 20%. One of the reason why the passenger vehicle sales has been come down is the semiconductor shortage. Because of supply issue, only the passenger vehicle sales has come down, and what the industry sources is telling that it will take another 6 months for passenger vehicles to pick up, because the semiconductor issue has to get sorted out, and it will take 6 months to get sorted out. The others tractor also little down. The reason is that there was heavy rain in the seasonal rain in the month of November, which dented the sales of tractor. Commercial vehicle has done well, and a three-wheeler has done well. Two-wheeler actually it is minus 0.75. It is not 0.75, marginally down. The passenger vehicle sales will pick up only after the semiconductor issue gets sorted out. So auto sales overall it is little weak, retail auto sales. The other important event which has happened which led to our market correction of around 6 to 10% the last 1 month was the COVID fear, which has resurfaced, mainly because a new variant has come, Omicron, and what the initial reports came was that it was more contagious. The one soothing point and one positive point was that even though it is more contagious than Delta, it is less severe. The hospitality case and the death case has been extremely low when compared to Delta, but only time will tell how serious it is. But in my home state in Tamil Nadu and all, people are extremely normal. No one is wearing any mask, and they are casual as usual. But still, there is no corona in my city, Madurai. Daily 6 cases or 8 cases are coming, and people are as normal. Everywhere the crowd is there, and no one is wearing mask. But still, in that the cases are not increasing. Only in Kerala, it is slightly higher. Day by day, it is coming down. But healthcare authorities are very cautious on Omicron variant, and they are taking precautionary steps. I expect there won't be any full lockdown unless otherwise a lot of death happens, or hospital overflows with patients. That at that time only the government will think of lockdown. Otherwise, the government won't insist on lockdown because they don't want to disturb the economy again. In some European countries, they have put some lockdown because the cases has gone up very sharply. And this is the global COVID cases. And if you see that almost we are in the 4th wave now. And the main reason for the 4th wave is the more cases in countries like UK, Germany, Russia, in this type of country, mainly European countries and countries where there was extreme cold. And these type of countries, the cases are spiked up a lot, and it is even the cases are higher than the second or third wave. And that is why the global cases are again on the upside. Almost to 4th wave we are running. This is after almost most of them putting the 2 doses of vaccine. And India, luckily the cases are still below 10,000, and I hope that by God's grace we won't get another wave. So it's one important slide I want to put in this time. It's a very interesting slide. It is the slide of the total government debt. Most of them won't be knowing how much debt the government has now. Both central government and state government, they take debt to spend money for the economy. And if you see that few years back, that around 2013-14 level, our MD used to take presentation. At that time, we used to put the government debt, central government debt, how much it was. At that time, it was 50 lakh crore. After 6 years, if you see that the central government debt has gone to 106 lakh crore, more than doubled what it was 5 years back. And the state government debt, that is all state governments take debt separately. Kerala government take debt, Tamil Nadu government take debt, Maharashtra, almost all state governments used to take debt separately. Central government take debt separately. And if you see that the central government debt in FY20 was 106 lakh crore, and state government is exactly 50%. That is 50 lakh crore. And during the COVID time, they took extra debt, and it was 120 lakh crore debt, and state government almost half of it, 61. And in FY22, that is in current year ending, it is expected that the central government debt will zoom to 140 lakh crore debt, and state government exactly 50% of that, 70 lakh crore. So the debt, the government debt is a never-ending liability which we are putting on our future generation. Why government debt never comes free? You have to pay the interest for that, and whatever tax are getting collected from people, all a major part of it is given for interest payment. Because when government takes debt, means right now government is taking debt around 6.5% government is taking debt. In current year, if government takes debt of 10 lakh crore, means next year they have to pay 65,000 crores worth of interest they have to pay for the debt they are taking in for current year. So it's a liability keep on going up. It never get reduced. And if you see the central government and state government keeps on taking debt, means what will happen is that they have to pay a major portion of the income, whatever they are getting, to spend for the paying interest. And paying interest is the first liability the government has. The second major liability is the salary and pension payment, and third one is the subsidy payment, and the fourth one is the spending like military and other, which is also very important. And fifth one is the social sector, where companies are giving freebies, in especially if you take states in Tamil Nadu and all. Government used to every year government used to announce a lot of freebies to the citizen. Now recently the ladies passenger, if you take a town bus in Tamil Nadu, government run a transport corporation bus in Tamil Nadu, ladies, you do not need to take any ticket. So that money ultimately has to be borne by the government. If something is free for a citizen, means money will not come from heaven. It has to be borne by the government. For that, what government used to do, they will take debt and give their transport corporation for the smooth running of the transport corporation. So the five major liabilities, the first one is the interest, the second one is the salaries and pension payments, the third one is the defense payment, then you have subsidies, then you have social sector spending. All this money will almost whatever tax are getting collected, it will get exhausted because of this. Then if you want to put road and other capital expenditure, means then you won't have any money. For that, the government has to take debt, and then they will spend. And if you see in the last 3 years, the spending has gone, the government debt has gone up very sharply because of COVID, and the government interest payment likely to shoot up very sharply in coming years. And that may force government to less spend on capital goods. Suppose if tax payments gets lower because of if economy slumps, means then the government will be in a major trouble. Because of interest rate fall, the interest payment has come down. In early 1990s and all, interest payment used to be around 13%, 14%. From there, now it has come to 6%. So that is the big cushion available for our Indian government, which forces them to take the debt and spend. But it is an ultimate liability for every citizen. And one day or other, if not we, our future generation has to pay the debt government is taking. If I take a debt, means bank will ask for me to pay it. If government takes the debt, means right now the prime minister is Modi. After 10 years, he will take debt for 10 years. After 10 years, the other person will be the prime minister. So debt will be transferred to him. So if a country take debts, that means there is no liability for an individual person. Whereas as a family member, if I take a debt, means then I am 100% liability. That is why most of the governments they will keep on taking debt without thinking that how we are going to pay it, because tomorrow somebody will be there for to answer for the liabilities taken by the current government. That is going on for the last 50 years. We have to see how this pan out. Once this will take a better shape, once the interest rate starts going up. If inflation goes up, means then interest rate will go up. At that time, most of the government, not only I'm telling about India, entire world, US government has taken a record debt, a huge debt they have taken. Similarly, the Japanese government has taken, European countries, almost entire countries have taken a lot of debt. The majority of countries have taken debt. All this will see some problem when inflation goes up and interest rate starts going up. A public issue is on top here. There is a saying that make hay while the sun shines. Now markets are doing well. So whenever market is doing well, lot of public issue used to come, and you can see that in current year 21-22 till November, almost 1 lakh crore has been raised, and previous the highest was in 2017-18. At that time market did well, almost 1 lakh crore has been raised. Now within 8 months it has crossed that level, and in December, if you see in the last week, the just ended week, we have seen 4 IPOs came, and in coming days also a lot of IPOs come. Generally in bull market only most IPOs used to come, and that is why we are seeing lot of IPOs happening. So it is not only the companies are getting listed in unlisted segments. If you see Indian startups, also you can see that huge capex has been, a huge amount of money has been raised, which is the highest money raised. It is the calendar year. Previously, what we have seen is the financial year, and this is the calendar year ending. And if you see that almost 17 billion worth of money has been raised till the 9 months in the current financial year. So whenever money is raised in capital market, means what is to happen is that many people will get employment, because a company will do capex, company will put in office, and they will give employment to new employees, and capital raising will always lead to good economic growth in near term. And we are seeing that money is raised in both the listed space as well as in the unlisted space, and that will help the economy in creating employment. Crude oil, it is extremely volatile, going up and down. It has to be crucially watched. And FIIs, I told you previously that they have been under continuous selling. And if you see in the last 10 years, only in FY16 they sold 2 billion. In all other years, either it was flat or inflow has come. So after FY16, in FY22 there has been some selling. FIs are selling only in secondary market, but they are buying in the primary market. That everyone should understand that. So whatever IPOs are coming, many IPOs foreign investors have been buying that share, and they are selling in the secondary market. And net inflow is 3.2 billion from April to till December 7th. And and if you see that last year is we can see that one of the biggest inflow we had ever, highest ever, that is 6 billion in FY21. And in rupee term, if you see that it is almost 2,70,000 crores worth of foreign money came in FY21, and it is the highest ever. And almost 26% of whatever money FIs have invested from 1993 to FY21, 26% of money came in a single year. Almost 1 quarter of that money came in FY21. And FIs were allowed to invest in India from 1993. At that time, Dr. Manmohan Singh was the finance minister. At that time only, India opened our capital market to foreign institutional investors. From there onwards, they are investing. And last year was a bumper inflow, and this year there has been slight outflow till date. Mutual funds doing very well. Whatever FIs are selling, it has been bought by domestic institutions, domestic mutual funds, and as well as by retail investors. And if you see that the last month almost 10,000 crores it has come, highest in the last 4 years. Whenever market falls, I have seen this. Whenever market falls by 5%, 10%, the equity inflow used to be very high. If in the mutual funds, because our investors generally put money whenever market falls, and the SIP, which is in the bottom 11,000 crores, it has been continuously going up, and SIP book sizes has crossed 11,000 crores in the month of November. And what we are expecting is that the money which has been coming in the mutual fund as well as through direct is just a tip of the iceberg, and the cycle has just started, and we expect in next 2 years, 3 years, in 5 years like that, more money will come into the mutual funds as well as in the stock market, directly or indirectly. India is one of the country where the in financial savings equity is very low when compared to other countries. If you see that in India, in financial savings, almost bank deposits contribute 57%, and insurance 23%, cash and currency 13%. Equity is just 7% of our financial savings. Whereas in Korea, it is 22. In Germany, it is 22. Poland, 26. European countries like Poland, it is in France 35. Then China, it is 41% equity. And Brazil 23, Mexico 35, and US it is 50%. So India is one of the country where the equity exposure is very, very less through direct as well as through mutual fund. Just 7%, one of the lowest globally among developed countries as well as developing countries. And the financial assets average of is around 30% for emerging markets, whereas India is just 7%, and we expect it will gradually go and it will double from here in the next 5 to 10 years, and that means that more money will come into mutual funds and through directly investing. Conclusion, my view is that market will see some consolidation in December. After second week, most of the FIIs will go for holiday. So once they go for holiday, means naturally the FII selling also will come down in the month end onwards. After 20th, the FII selling also will come down, and I don't expect much fall, because once the FII selling comes down, means there is a possibility of that even a small buying by domestic institution may push up the index, and index will see some consolidation. But in January, I'm expecting a pre-budget rally, because the January is expected to be on February 1st. Historically, Indian market used to see a very strong pre-budget rally, and this time also I am expecting it, and January will be a better month. Events to watch, foreign force we have to see, and then the US topper. Yesterday US inflation came, and then if you see the inflation rate, it has been 6.8, highest in recent times, more than a decade. This inflation US hasn't seen it. If inflation continues to be very strong, means then what will happen is that the tapper will come very sharply, very fast, quicker, and then the Fed may increase the interest rate, and we have to closely watch that data. So that is the presentation for now. We will see the recommendations. So 5 stocks which we are recommending this time is the the first one is the Cadila Healthcare. Most of the pharma stocks has corrected a lot in the last 3-4 months, and we expect some value is emerging in the pharma stocks. So previously also we have recommended the Cadila at higher rate. So somebody who has bought it, means they can current rate can buy and average it. So that is the first company we are recommending. The next 3 companies, as I said, is the capex related companies. ISTech. It is a heavy engineering company. They have a small sugar division also. They manufacture boilers and other engineering equipments which is used for capex. And this company we are recommending this time. And some of the companies like Thermax, Siemens, ABB, they are all available at a very high valuations, though we cannot exactly compare with it, but still this company may be a beneficiary in the capex revival cycle. The third one is the Carbon Universal, which is the abrasive company. Last time I recommended the Grindwell Norton, which is also a company which is almost like the Carbon Universal, which is in the abrasive sector. And this time I have recommended Carbon Universal. And whenever capex comes, these companies tend to benefit because a lot of abrasive material will be used for setting up plants, for constructing and for installation and all. And this company will be the beneficiary. And fourth one is the SKF. Last time I recommended Schaeffler, which is in the ball bearing and precision. This time I am recommending SKF India, which is the Swedish multinational Indian arm. And that company also will get benefited because of auto sector revives and industrial sector revives, means SKF will get benefit. And fifth one is the special situation. Previously, I have recommended a special situation, which is the India Bull Real Estate. This time, I am recommending a company called Raymond, because Raymond, they have a poor corporate governance track record in the past, but the management is told that they are going to list their subsidiaries. 3-4 business division they have: retail division, textile manufacturing, retail, real estate, as well as a company files division, which is related to the and then they have the auto ancillary also. They have five business division they have. Now JK Files has filed their drafted rendering prospectus to SEBI for coming out IPO. So whatever money they are raising through that, almost 800 crores they are planning to raise by listing JK Files. And all the money will go to the parent. Right now it is 100% owned by Raymond, which is the parent. Once it gets listed, means 800 crores Raymond may get it, and value unlock will happen. So they are planning to list one by one company, and if that happens, means Raymond will get re-rated. We should remember that in the past Raymond corporate governance was very bad, and we have a hope that they may come clean, and that is the with that hope only I have recommended this Raymond stock. And if you see the monthly review, November review, if you see that, I have recommended 5 stocks. Manappuram did very badly. I recommended on Saturday. In the Monday onwards, it fell because exactly on the day I recommended, result came. It was not up to the expectation. Monday itself, it fell by 10-15%. It fell last month. If you leave aside Manappuram, all the companies has done reasonably well. Grindwell, Norton, and Schaeffler was in positive. Polycap, it will do well because on capex revival, and next to somebody who is having Polycap, they can continue to hold for 2 years. It will do well. Airtel also will do well. There are talks that recently Airtel and Vodafone, Jio all have hiked prices for their telecom services, and now there are reports that Vodafone Idea may raise some money from the market, and if that happens, means Airtel may underperform a little bit, but all the telecom companies will do well in coming days as they have high charges. The survival of Vodafone Idea has improved now post price hike. So except Manappuram, the other stocks are have done well. Manappuram will do well once gold prices start increasing. So these are the review as well as these are the recommendations.